That's your money saying it's time for a McDonald's run. Because with new McValue at McDonald's, you get more than you expect. Like buy a 6-piece McNuggets and add a McChicken for just $1. Your money says let's go. Get more than you expect with new McValue. Prices and participation may vary. Valid for item of equal or lesser value.
Reality radio for a really great future. We're talking real money.
Hello again. Welcome to the Daily Podcast. I'm Don McDonald. Another short week for us this week as I was flying on Monday, and I'll be acting in a student film, on Thursday and Friday. Also, our radio show that we turn into 2 podcasts and would have turned into 2 podcasts next week is preempted again this week. Just what's the date? Just so you know, the 28th of September. So we'll have daily podcasts next week. We have a couple of daily podcasts for you this week, the one I did yesterday and this one today. And again, you can call me with your questions at 855-935-TALK, 855-935-8255. Couple of things I want to talk with you about. One, yesterday's news. I don't care what side of the debate you come down on, events like this can be worrisome. What am I talking about? Oh, yeah, the beginning of an impeachment investigation in the House of Representatives against the president. It hasn't really affected the markets, and we don't generally talk about the markets day to day, but this is one of those events that no matter what direction it takes, we've been through things like this. We've been through far worse than this. And it tends not to have any lasting impact on the market. So you don't even need to think about it when it comes to your investments. Oh, and there's one other really interesting thing that I just read that should give you some comfort going forward. You know all the talk about the inverted yield curve? You probably heard it. You know, the inverted yield curve is predicted every recession. An inverted yield curve is when a normal yield curve, short-term Treasury bonds yield less than long-term Treasury bonds because the farther out you go, the greater the time risk you take with your money, so you expect to be rewarded for that. Doesn't always follow that you are, but you expect to be, and that's the normal yield curve. Well, lately, or in the past month or so, we've had a couple of periods where the yield curve did what is called inverting. It inverted, which meant that the long-term bonds yield less than the short-term bonds. And that is used by the media to scare you. It's supposed to be worrisome because the media likes bad news. It's exciting. Well, recently, and I just heard about this not long ago, Professors Eugene Fama and Kenneth French, Fama who won the Nobel Prize from the University of Chicago, Booth School, and Ken French from Dartmouth, did a paper on this topic. The paper's called of course, as most papers, the titles are boring. It's a academic paper. Inverted Yield Curves and Expected Stock Returns. And the purpose of this research was to not look at whether or not an inverted yield curve predicted a recession, but to determine if a inverted yield curve was an indicator that you would make less money going forward for a period of time in stocks. Because that's what the real fear is. It's not the economic fear. It's, am I going to lose money in my investments, my equity investments? And let me tell you, unless you're an academic, the paper will glaze your eyes over, as it did mine. I've read a lot of them, and I have to read papers like this a couple of times. But here's the gist of it. When 10-year treasuries yield less than 2-year treasuries, people suggest that you move your money into shorter-term treasury bonds out of the stock market. But the reality was they looked at 1, 2, 3, and 5-year periods after the yield curve inverted, and they found that stocks actually outperformed bonds over all of those periods. You don't even have to, it's of course a given that they performed over longer than 5-year periods. But in every period they looked at, every rolling period they looked at, the stock market outperformed bonds by 1 to 2% per year for 1 year after an inversion, 2 years after an inversion, 3 years after an inversion, and 5 years after an inversion. This is really important because what it tells you is that this news, there's no need to pay attention to news like this because you can't do anything about it. Remember, this is so important for you to remember as an investor. The stock market rarely reacts to events unless they're a total surprise. And things like a inverting yield curve are happening because of a lot of economic factors. They're never a surprise. A surprise is 9/11. That's a surprise. A surprise is Pearl Harbor. That's a surprise. Otherwise, these other things are non-events. Non-events in terms of your equity portfolio because you can't act upon them. So this is another great example of you being unable to do anything with the news that you hear. You can't. It's too late. This is why you build a portfolio for your need and tolerance for volatility. Not even really risk, just volatility if it's diversified enough. And let me tell you, this the summary of the paper said, and this is really what you should take from it. This is a quote from this paper, Inverted Yield Curves and Expected Stock Returns. Quote, "We find no evidence that inverted yield curves predict stocks will underperform Treasury bills for forecast periods of 1, 2, 3, and 5 years. You cannot predict the future, period." That is the message you need to take from this podcast. That is the message you need to understand about everything in life. You may think you have predictive powers, but you don't. You have gut feelings. And feelings are right sometimes and wrong at others. The problem is the way our brains are wired, we tend to give more credence to those times when we get it right, and we, of course, hate to admit we get it wrong, so we forget those. Stop trying to predict. And give me a call anytime at 855-935-TALK, 855-935-8255, or you can send your questions in to us at talkingrealmoney.com using the Contact Us form, and we're here for you all the time. Give us a call or send us a note, and call 855-935-TALK or go to talkingrealmoney.com. And we'll talk to you again next week on Monday, which will be the last day of September. And I hope you have a wonderful weekend. Thanks so much for listening. I'm Don McDonald.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.